Hi everyone, how's it going? Today's video is about the one simple entry rule that will boost your accuracy without complicated indicators. You may be having some issues with working out where to enter, when to enter. This video may clear that up for you. And this is something that I use very often to boost the trade accuracy. Sometimes you're not quite sure, you're hesitating, you're thinking, I should have, I shouldn't have. Perhaps this will clear it up for you. So let me talk you through what we're actually looking at. So first of all, not every setup that looks good is the same as another, and we'll talk about why. And this will filter out low quality setups or low probability setups. You'll see why, and it will give you a place to focus your entry on as well. So you'll know with a bit more precision, a bit more confidence, why you should focus your entry in that area. And also the result is it will give you a higher risk to reward scenario and improve your accuracy as well. So let's begin and talk about why that is, how we're going to look at it. This might give you a little bit of a shift in looking at the chart in a particular way. So first of all, have a look at these. Don't rush to watch this video or forward it, but really take a look and see what is the real difference between these two setups. So first of all, if we just look at these, what I could tell you is that both of these are euro dollar, so EU, and both of them are on the 1 hour time frame. Okay. And what we could see, we've got a downtrend here, perhaps we have a downtrend here. We have on the chart to the left a high and a low. We're looking for that retracement to continue. And then here we have a high, we have a low, and looking at the retracement level to continue. So on the surface, they look quite similar, look very similar. This is both the same time frame. What is the real difference here? Well, perhaps I'm not giving you the full context, but where are we on the chart? And more precisely, what is this in reference to where we have been before and at the time that we are actually trading? Now we know about different sessions. We also know that we have different candles. The start of the week and the end of the week creates the open price and the close price of a candle. And what about this? So if we have the 1 hour, let me show you what we're looking at. So let's just erase all of that. And let me put this on the chart. Now, you can see that what I've marked here is the close of the previous day and the open price of the current day, which was right here. So this is the previous B1 daily candle close. So the candle opened and it may well look like something like this, right? And now the candle has opened here. And what we see is that price right now is just moving slightly above the open price or the close of the previous day. On the chart to the right, we have the close or the open of the current day right here, and we moved lower, and now we are slowly retracing up. So the previous candle, previous day, was something like this, if you add up all the candles together, right? Now, why is that? And why is that significant? Let's erase that. And why is that significant? Well, what you will see, or you will tend to notice, is that we have, as candles move, we have several things that you can notice about the candles. So when you are in a trending market, if you take the trend of these candles, we have the close price, we have the candle move higher, come down, and then close. So if it was a bar chart, it would be the open, move up, come down, and then close. And then it would open, move up, come down, and then create closing price. And let's have a look at it on a chart here. In this case, we're just going to look at the daily chart, but it doesn't matter. What you will see is that if we start here on the left, every time we have a trending market, so for example, here we had a nice bearish candle. What happened? The price moved lower, closed, opened, the next day moved higher, created this wick, then continued lower and closed. Closed, the next candle opened, moved higher right here, and then came down and closed. The next day, continuing bearish, 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 was the open price, moved higher, and then moved lower, and then closed bearish. In this scenario, we opened, we went lower, and then moved higher instead. So the opposite, we had a reversal, and then it closed bullish. What relevance does this have for you? Well, the point here is that in order to get a better price, in order to get a more high probability trade, it's worth waiting for price to create that move, first of all, the retracement, first of all, in the opposite direction before continuing. So it will create that wick of the next candle. So if you're an intraday trader, you will look at the daily chart and you will wait for that wick to develop and then reverse. And if you are a swing trader, you could be looking at this chart, could be the weekly, for example. So if we look on the weekly chart, we have a similar thing here. So in this case, we had this big pin bar. We had a very, very small retracement, tiny retracement here that left a wick and then headed lower, almost nothing. In this case, we moved lower first, went higher, and then closed. And then the next day we continued again. So this may not be the same. And then this day we made a little tiny wick here and then continued lower. So we want to capture that wick on the higher time frame, and on the lower time frame get our entry. Now there may be times when you will not quite get it right, and these pullback days may not be winning days, they may be even losing day or break even, or you may not want to enter. So the difference between those two charts, let's go back to them again. So the difference between these two charts is that where on the left we opened and then we moved higher, we're looking for a higher price, which will be above, which will be the wick of the next daily candle. On this occasion, we did not move higher. Instead, the day moved lower. As you can see here, the candles move lower, and we're now trading below the open of day. And in this case, on the left, we're trading above. And we want to see it above, because above is that move that we want to see a more expensive, a better price, and that gives us the wick if the day turns around and then continues lower, the wick of the daily candle, of the high time frame candle. Now, if this chart that you see here was the 4 hour, then we will be considering the weekly time frame, the weekly candles. So let's have a look at what actually happened in the aftermath, what can typically happen. So here we are, and as you can see, we have the open moved higher. We did not breach this high. We turned around and ran really, really quickly lower. In this case, what did we have? We did have the pullback. We had possible entry here. It ran briefly lower, but then turned around and created a big mess and ultimately ran higher. Which one was better quality? Well, of course, this one to the left. Why? Because we did not run lower. We can see we left these wicks, but instead we went higher first. So this is that run, that wick, which created, if you see the candle will look something like this with the wick, and then it ran lower. Right? So the open, so the close of previous day, the open of the next day, the wick to the upside, and then heading lower. If you add this rule, if you add this idea to your trades, to your entry criteria. What you'll find is that the best trades, the way to filter out low quality trades and leave the best ones, is to just use this principle. So the principle of selling from a higher price, buying from a lower price, meaning the lower, we need to move lower first if you're in an uptrend, and if you're in a downtrend, we need to move higher first. Then we want to see the reversal. Now, that's not to say that these trades here will not work out. Who knows, maybe it will run lower and lower still. Now, that is not, obviously that happens, and obviously that will keep happening. However, when you want to place the probabilities in your favor, the probabilities stack up much better when you have this rule added. You can trade this, you can enter it on a lower time frame, you can take quicker trades, you can take less risk to reward, and you can still have winners. That's not to say that you won't. However, we're just placing the probabilities in our favor. That is the purpose here. So this is the idea, to add this criteria to your entries, and then you will see that over time, when you get a real trend developing and you're really strong trend, really confident about your trend direction, this will add to your accuracy. So in summary, use the higher time frame analysis candle to determine the close and open price. You may have seen this table before that we looked at in another video of time frame combinations, and what that means is, as just mentioned, if you are analyzing the weekly, obviously you want to see the open price, and let's say if you're in a downtrend, the open price to move higher. We're talking about the 4-hour move higher, of course, it'll move higher, and somewhere here there'll be a reversal and then continuing down. And it will be the same with 4 and 15 minutes, the same pattern, the same idea, or open, move lower, and then continuing on the uptrend. So that means you buy below and then you sell above only on the lower time frame. And you combine that with levels, zones, whatever other confluences you have, fib levels, Fibonacci, to create a confluence, to combine them together so that they are both, that they fit together, not just because are higher or lower. So if we look at this one again, for example, then we have a high here and a low here. And between here and here, we will have perhaps a fib. This will probably be a 61.8. We also have a level that you can see here. So all of that is interesting and provides a context and a confluence for a high probability scenario, basically. These work on every single candles, not every single time, but almost always we have some kind of move in the opposite direction. I mean, you could see it just in front of you on these candles. Even if this is a 1-hour chart, we still have that happening. So for example, if you take these two candles, previous one was bullish. Here we opened, we went higher, then we went lower. So in this case, because it went higher first, this would not be one for us to look at. And it would be the same thing here. If you look at these two candles, on this candle, the close was here. It went lower first and then it headed higher. So what we want, if we want to continue going lower, is a higher price first. Since it didn't do that, then this is not valid. And then these two candles, this one next, we opened right here, we went lower. So inside of this level, let me just clean that up so it's a bit easier to see. Inside of this candle, this white candle, once the market opened, went lower. Here, somewhere within here would be an entry, and then it headed higher. Of course, the best trades are the ones that are on with the trend and very clear, very clean, simple trades that are not in a ranging environment. And when you wait for those and apply this to your setup and the time frames you trade with, and you can use the table as your guide if you haven't watched that video, time frame combinations, then these are high probability scenarios. So thank you for watching. I hope that helps you and improves your trading. Remember, anticipate a move in the opposite direction first before your entry. Bye for now, guys. I will see you on the next video.